billion a year, $500 billion in spending, about $300 billion in tax cuts. Why can't it be bigger? I expect it can't be bigger because I expect, again, just my view, that our president-elect wants to get a lot of Republican support. Not just to get it through Congress, but also so that Republicans feel some ownership of this, so that it's really a national effort, so it is a nonpartisan effort. But in trying to get Republican support, and also the support of fiscally conservative Democrats, known as Blue Dog Democrats, there may be a danger of just making the stimulus too small. Those of you who remember the 1930s, I don't think anybody here remembers the 1930s. Those of you who remember reading about the 1930s know that Franklin D. Roosevelt tried in the 1930s. Most people involved in public policy or economics stopped using the word depression because, frankly, it was depressing and it scared people. Now, this deep recession that we're in, or if you don't like deep recession, call it liverwurst, or mini depression. I tried to call it a mini depression not long ago, and it scared too many people. Whatever you want to call it, it is unlike any recession we've seen in previous years, both in terms of the sharpness and severity of the downturn, but also the fact that most of our previous recessions were brought on by the Federal Reserve Board raising interest rates too high in terms of trying to overcome inflation, putting brakes on it so tightly that people see asset bubble having burst. And the asset bubble, when I say huge, I mean it's much larger than anybody understood at the time. It is not just housing assets, but it's all the derivatives attached to housing. And once you get all of the derivatives, and those derivatives, by the way, have a lot to do with what happened to Wall Street over the last 5 or 6 or 10 years. The leverage that we never expected, some of us who looked at the data knew that there was a lot of leverage, and people were scratching their heads and wondering, how can Wall Street continue to function with this kind of leverage, making these bets? But I must say that I, among many, many others, assumed that Wall Street knew what it was doing. And it obviously did not. How to get out of this? Well, I've already talked a little bit about that. What are the lessons that we can learn from this? One that I have not mentioned in Wall Street. Now, when I say smarter regulation, I don't necessarily mean more regulation. I mean smarter. What kind of regulation? Number one, we have to have better capital requirements for financial institutions. They cannot leverage themselves like they have. A lot of the leverage was done off balance sheets. Number two, we've got to have better disclosure. Even a lot of big institutional investors did not know what they were actually investing in. Number three, we've got to get rid of conflicts of interest, like the credit rating agencies, who are being paid by the issuers of the securities that they rate. Talk about a conflict of interest. Number four, I think there should be some attention paid to how executives are paid. Maybe because all of the incentives now and recently have been on making huge killings with as much leverage as possible and making as much money as you can off of those huge bets because you're raking in a portion of those bets and then just basically moving on to the next big leverage bet. Now, those will not completely solve the problem, but those are some of the lessons, hopefully, we've learned.